Mr. Secretary, I'm somewhat troubled by recent reports that some banks have taken stimulus payments from individuals and families with garnishment orders or negative account balances to offset unrelated debts owed to them. I find it troubling that banks would serve as debt collectors at a time like this when families need the resources most. When will Treasury issue guidelines articulating your expectation that financial institutions refrain from taking stimulus funds away from their customers during a time like this?
Well, let me first say I agree with you and that I think it would be awfully unfortunate if banks are doing that. We have had inquiries about the issue of garnishment, and we agree from a policy standpoint that there should have been no garnishment. Unfortunately, that's something we need to address in the next CARES Act if we do additional direct payments, because there are certain state laws that were not overridden in the existing CARES Act. But my understanding that's a state issue and not a federal issue. We agree from a policy.
But think about the cruelty of the policy. Wouldn't you want to?
As I said, I agree with you on the policy.
Couldn't you all issue a blanket?
We've asked our legal department, and unfortunately we can't, and that's one of the things we would want to fix in the next CARES Act. So we agree with you from the policy standpoint.
Thank you. Chairman Powell, for many nonprofits and small businesses, earnings before interest, taxes, depreciation, and amortization is not a widely used metric. Have you considered applying other metrics of debt, future growth, or financial health to the Main Street lending program so that nonprofits and small businesses are fully able to participate?
Yes, as a matter of fact, we have, particularly for nonprofits, of course, earnings before interest taxes doesn't make any sense. So you don't need to take taxes out. They're nonprofits. They don't pay tax. So we're looking at a range of, and we actually put this out for comment. We got a lot of very thoughtful comments from the nonprofit community of looking at cash flow and also financial resources more broadly. In terms of companies, EBITDA is just basically pre-tax cash flow. It's a very widely used metric, but there are other metrics. And as the Secretary mentioned, one of them, probably the next one in line, is something along the lines of asset-based, and that's something that we're looking at with the Treasury.
Now, under the Main Street lending program, you reduced the minimum loan threshold from $1 million to $250,000, and then by expanding the program to nonprofits with more than 50 employees. However, many small businesses may not need $250,000. Mr. Chairman, has the Fed considered eliminating the minimum loan threshold altogether?
We have not considered eliminating it yet. Of course, and we're just now getting rolling with loans, as you know. So we can, once we get up and running, look at lowering it again. But you get into a very different kind of lending when you're down lower. These are really personal loans rather than business loans. They're generally guaranteed by the business operator. And we could look at that, but that would be something we'd look at once we get up and running.
Yeah, but I mean, it's kind of concerning that you have that threshold at $250,000 when, say, a small business in St. Louis needs $100,000 to survive through this pandemic until they get back on their feet. Any consideration given to accommodate?
Yes, no. We can see ourselves possibly lowering the threshold again, but just logistically, for us to be making very, very small loans would be difficult, and those people may be better dealt with through fiscal policy. But I can see us down the road looking at a lower threshold.